I was sitting there this morning, coffee in hand, uh, staring at my trading app, just watching the numbers tick.
Right.
Green, red, flashing, moving. And I had this moment where I tried to visualize, really visualize who was on the other side of the screen.
It's a natural instinct.
Yeah.
You picture a person.
Exactly. I picture some guy in a fleece vest in Midtown Manhattan screaming into a phone. Or maybe a day trader in his basement in London with, 6 monitors.
The classic image.
We have this very romanticized view of the market as this sort of town square. Buyers and sellers, humans, making decisions based on fear, greed, maybe a little bit of research. But we have a stack of research on the desk today that suggests that image isn't just outdated, it's a complete hallucination.
It's a relic. It's like thinking your email is delivered by a postman on a horse, the market you're imagining. That died about 20 years ago.
So let's rip the Band-Aid off immediately. If you were trading U.S. equities today, stocks like Apple, Tesla, Nvidia, what is the reality of the person on the other side of that trade?
The reality is staggering. And, staggering is a word we overuse, but it really fits here. According to the composite data we've pulled, looking at exchange reports and this RedTeam analysis, nearly 95% of equity trades on U.S. exchanges involve algorithmic strategies.
95%.
Yeah, 95. And it's not just stocks. If you step into the Forex market, currency trading, it's 92%.
So to be crystal clear for everyone listening, if I click buy on my phone, the odds that I am buying from another human being are, what? Statistically zero.
Basically zero. You are not swimming in a pool with other people. You are swimming in a pool filled with sharks. But they aren't biological sharks. They're silicon sharks.
Still in sharks.
Yeah. They move in milliseconds. They do not sleep. They do not feel fear. And they do not hesitate.
That's terrifying. It feels like we brought a plastic knife to a nuclear war.
It can feel that way. And that's usually where people stop, right? They hear high-frequency trading. They hear algorithms. And they think, well, the game is rigged. I can't compete. I'm out.
But that's not why we're here. Because the sources we have today, specifically this fascinating breakdown from the RedTeam, propose a twist.
A massive twist. The whole premise is built on it.
These machines are fast, yes, but they have a fatal flaw.
They do. They are coded, they follow rules, strictly defined, rigid logic. If X happens, do Y. And because they are bound by these rules, they are, in a weird way, predictable.
Ah, I see where you're going. Because they're rigid, they leave a trail.
Exactly. They leave footprints. Massive, heavy footprints on the charts that human eyes, if you know what to look for, can actually see.
So the mission for this deep dive is pretty specific. We aren't trying to outrun the robots. We know we can't do that.
You'll never beat them on speed, ever. It's a fool's errand.
Right. So instead, we're going to learn to be trackers. We're going to decode the invisible hand.
We're going to turn you into a forensic analyst of the market.
I love that. So here's the roadmap for the next hour or so. First, we need to understand the beast. We're going to look at the scale of this machine dominance, the physical infrastructure, the latency arms race, the stuff that physically makes the market move.
Then we're going to open up what I'm calling the bestiary.
The bestiary, I like that.
Yeah, like a medieval field guide to monsters. We're going to classify the different species of bots. You have your high-frequency scalpers, your range-bound bots, your massive iceberg orders. They all have different personalities, and they all leave different tracks.
And then we get tactical. We're going to walk through the forensics, looking at volume, candle shapes, and order book data so you can spot them in real time. And finally, the RedTeam strategy. How to survive and hopefully profit in the water with these sharks.
It's about moving from being the prey to being the remora. You know, the little fish that swims next to the shark.
Right, it catches the scraps.
It rides the slipstream. That's the goal. Let the shark do the work.
All right, let's dive in. Section 1, the scale of the machine. We threw out that 95% number. But I want to zoom out for a second. Is this just a U.S. phenomenon, or is this a global takeover?
It's definitely global, but the U.S. was the laboratory where this monster was created and perfected. If you look at the global transaction data, about 70 to 80% of all market transactions worldwide are automated.
70 to 80%.
Yeah. North America leads with about 41% of that total volume, but we're seeing explosive adoption in Asian markets and Europe. It's the new standard everywhere.
But the volume, I was reading the notes on the daily order count. This number just seems impossible.
It sounds fake, but it's real. U.S.-based exchanges process over 9 billion, that's billion, with a B algorithm-driven orders every single day.
9 billion. That's more orders than there are people on Earth. Daily?
And here's the kicker, the part that really breaks your brain. Most of those orders, they never result in a trade.
They place the order, and then what happens?
They cancel it, sometimes microseconds later.
Why? What's the point?
It's part of the strategy. They're testing liquidity, they're hiding their intentions, they're trying to confuse their competitors. We'll get into, quote, stuffing and spoofing later, but just understand that the noise in the market is billions of times louder than the actual signal, the actual trades.
So it's like a constant cloud of digital chaff. That's a lot to sift through. Now, to understand how they do this, we have to talk about infrastructure. Because I think a lot of people assume algorithmic trading just means good software. Like, I have a fast laptop, they have a faster one.
If only it were that simple. It has almost nothing to do with your laptop. It has everything to do with physics.
Physics. Okay, explain that.
We need to talk about the latency arms race.
All right, define latency for us in this context.
Latency is simply the time it takes for a signal to travel from point A to point B. In trading, it's the time from when you decide to trade to when the exchange confirms it. In the 1990s, we measured this in seconds. A human on the floor signaled, someone typed it in. Seconds.
Which seemed fast at the time.
It did. Then we moved to electronic trading, and it became milliseconds, 1,000th of a second.
Which is already faster than a human can blink. A blink is what, 300 milliseconds?
Exactly. But today, right now, if you are a competitive high-frequency trading firm, an HFT, a millisecond is an eternity. You might as well be sending a carrier pigeon.
So what are we at about now?
The standard now is microseconds, millionths of a second. And the cutting edge is pushing into nanoseconds, billions.
Okay, hold on. I can't even conceive of a nanosecond. Why does that matter? Price doesn't move that much in a microsecond, does it?
In the modern market, it absolutely does. Or rather, the information about the price changes. Imagine an event happens. Let's say the Fed releases an interest rate decision in Washington, D.C. That information travels down fiber optic cables.
Right, at the speed of light, basically.
Yeah. Well, close. More like 2/3 the speed of light in a vacuum. But the point is, the trader who gets that information 1 microsecond before the others can see the market's reactions starting to form, buy everything in front of that wave, and then sell it back to everyone else at a higher price a split second later.
So it's front-running, just on a technological level.
It's the purest form of technological front-running.
Yeah.
And this led to the phenomenon of co-location. This is one of those things that when you first hear about it, it sounds like a conspiracy theory.
I remember reading about this in Michael Lewis's book, Flash Boys.
Yeah.
It sounded wildly dystopian then. Has it just become normal?
It's the industry standard now. It's table stakes. Co-location means that trading firms, big banks, hedge funds, prop shops like Citadel or Virtue pay the exchanges like the NYSE or NASDAQ massive premiums
For what?
to rent rack space in the exchange's data center.
Rack space, like server space?
Physical space. They want their server to be physically located in the same room, sometimes in the cage, right next to the exchange's matching engine.
The matching engine being the actual computer that says buyer A meets seller B, the brain of the market.
Correct. Because here's the physics part. Every foot of fiber optic cable adds delay. It adds latency. If your server is in downtown Manhattan and the exchange's server is in Mahwah, New Jersey,
That's about 30 miles, right?
you lose. The signal takes too long. By the time your buy order gets to Mahwah, the HFT firm whose server is sitting inside the Mahwah facility has already seen your order coming, bought the stock you wanted, raised the price by a fraction of a cent, and is now waiting to sell it to you.
So they're literally fighting over the length of the cable.
It gets crazier. There are stories of firms analyzing the curvature of the cable inside the data center. They demand that every single firm has the exact same length of cable running from their server to the matching engine, often coiled up, just so that no one has a 3-foot advantage over anyone else.
We are talking about inches? That is insane.
We are talking about the speed of light. There was a famous case, a company called Spread Networks. They spent $300 million to drill a perfectly straight tunnel through the Allegheny Mountains.
Why?
To lay a fiber optic cable from Chicago to New Jersey that was straighter and therefore shorter than the existing railroad tracks that other cables followed.
Just to be straighter.
To shave off 3 milliseconds from the round trip time, and it was worth billions.
That puts my fast Wi-Fi into perspective. I'm sitting here complaining about lag in a video game, and these firms are tunneling through mountains for a few milliseconds.
Exactly. So when you sit down at your retail brokerage platform and you hit buy, just remember,
Right.
you are not racing these guys. You cannot race them. If you try to day trade based on speed, you are the roadkill.
Roadkill is a vivid image.
Yeah.
Okay, so we have the playing field. It's a hyperspeed, co-located, microsecond battlefield. Now, who are the generals? Who is actually running these boxes? Is it just the big banks? Goldman, Morgan Stanley?
It's a mix, but the balance of power has shifted dramatically over the last decade. The investment banks, the Goldmans of the world, they control about a third of the market, roughly 34%. They use algorithms mostly to execute big orders for clients.
Like, hey, a pension fund needs to sell its stake in Apple without crashing the price.
Right. They're focused on execution quality. But the real sharks, the aggressive for-profit ones, are the proprietary trading firms. Prop shops.
Games we might have heard of.
Virtu Financial, Citadel Securities, Jump Trading, Jane Street. These are firms that don't necessarily have clients. They trade their own money. And a massive part of their business model is something called market making.
Okay, we need to define this.
Yeah.
Because market maker sounds like a helpful job, like a baker making markets.
In theory, it is helpful. In the old days, on the floor of the NYSE, the specialist was a guy standing at a post. If you wanted to sell your shares of General Electric and there was no buyer available right that second, the specialist was obligated to buy it from you. He provided liquidity. He made the market.
He was the shock absorber for the system.
Yes. And he made his money on the spread, the difference between the buy price, the bid, and the sell price, the ask. He'd buy from you at $10 and sell to someone else at $10.05. He pockets the nickel.
And a nickel seems fair for taking on that risk.
Sure. But now, replace that human with a server rack in Mawa. The algorithms are the new market makers. They are posting buy and sell orders simultaneously, thousands of times a second on thousands of stocks. They provide the liquidity.
But they're not looking for a nickel.
They're looking for fractions of a penny, 1/10 of a cent, maybe less.
But they do it billions of times a day.
Exactly. They don't care if the stock goes up or down in the long run. They try to be delta neutral, meaning they have no directional bet. They just want volume, they want churn, they want to capture that tiny spread over and over and over again.
So when I see a stock price just wiggling around on the chart, that random noise where it goes up a cent, down a cent, up a cent, that's just them passing the hot potato back and forth.
That is the heartbeat of the machine. That is them harvesting the spread from the market's natural order flow.
It makes you realize how much of the market movement we see isn't actually sentiment. It's not investors believing in the future of the company. It's just mechanical friction.
It's mechanical respiration. But here is where it gets dangerous for us, the manual traders. Because these prop shops are for profit. They aren't a public utility. In the old days, the human specialist had a legal and reputational obligation to maintain an orderly market, even if it meant losing money.
Right.
The algo, its only obligation is to its code and its profit and loss statement.
Which brings us to the risks. Because if the machine decides it's losing money, or the risk is too high,
It stops. It just stops. It pulls the plug. It vanishes. And this is a perfect transition to how this technology evolved, and specifically the day the machines almost broke the world. We have to talk about the flash crash.
2010, the day $1 trillion just vanished.
Let's unpack that because it's the best case study for the double-edged sword of this technology. It shows both the efficiency and the extreme fragility it introduces.
So take us back. May 6th, 2010. What's the scene?
Well, the market is already a bit skittish. The Greek debt crisis is all over the news, so there's this underlying anxiety. But things are relatively stable. And then, at 2:32 p.m., the floor falls out. In a matter of minutes, the Dow Jones Industrial Average plunges 998 points.
Which was, at the time, the single biggest point drop in history.
It was absolute free fall. We saw blue-chip stocks companies like Procter & Gamble go from trading at $60 a share to trading at pennies. 1 cent. Accenture traded at 1 cent.
Imagine having a limit order sitting at a penny, just as a joke, and suddenly getting filled on thousands of shares of Accenture.
Some people did. But on the flip side, you also had shares of Apple trading at $100,000 for a split second. The entire pricing logic of the market completely collapsed.
What happened next?
And then 36 minutes later, it was mostly back. The market recovered the majority of the losses almost as fast as it fell.
$1 trillion round trip in 36 minutes. So what actually happened? Was it a human error? A fat finger trade?
Initially, that's what everyone blamed. But the official investigation showed it was a cascade, a feedback loop. It started with a large mutual fund, Waddell and Reed, that used an automated algorithm to sell a massive amount of E-mini S&P 500 futures. We're talking $4.1 billion worth.
4.1 billion, that's a heavy sell order.
They just wanted to hedge their overall portfolio. But they used a fairly basic algorithm that was instructed to dump it into the market based on volume, not necessarily price.
So it was a blunt instrument.
Very blunt. Now, normally, the market makers, the HFTs, would absorb this. They would see the selling, buy the dip, and smooth things out.
That's their job, right? Provide liquidity, capture the spread.
Right, but their internal risk protocols saw this massive unexplained volume coming in, and their code said, whoa, this is outside our parameters. This is too volatile. Abort.
So they ran away.
They all pulled their buy orders simultaneously. The liquidity evaporated. We call this ghost liquidity.
Yeah.
It looks like there are buyers on the screen on the order book, but the moment you actually try to sell to them, they vanish.
So that $4.1 billion sell order fell into a vacuum.
Exactly. There was no one there to buy. So the price just kept going down and down and down, looking for a bid. This triggered other algorithms to start selling, which triggered stop losses, which created more selling. It was a chain reaction.
That is the ultimate danger of ghost liquidity. It works until the one moment you actually need it.
Precisely. It works when the sun is shining. In a storm, the robots go home and lock the doors.
And this leads to an interesting point in our notes regarding, quote, stuffing and some of the darker arts of this world. Because it's not just about running away. Sometimes they actively try to break the system for their own benefit.
This is where it borders on, and in many cases has crossed into illegal manipulation. Quote, stuffing is a great example. Think of it as a denial of service attack.
Like you'd see against a website.
Exactly the same principle. An HFT firm will blast the exchange with, say, 10,000 orders for a single stock in a single second, and then in the very next millisecond, they cancel all 10,000 of those orders.
Why? If they aren't actually trading, what's the point?
The point is to clog the data feed. Every other trader, including you, me, and especially their competing HFT firms, our systems have to process those 10,000 messages. It slows our computers down. It creates lag.
So they create lag for everyone else so they can run faster in that brief window.
That's it. While your computer is choking on the 10,000 fake orders, they're sneaking in their real trade ahead of you.
That feels incredibly dirty.
It is. And regulators are constantly trying to catch it. They've introduced rules like order-to-trade ratios to penalize firms that cancel an excessive number of orders. But the algos are smart. They find new ways, new workarounds.
It's a constant cat and mouse game.
It is, but, and this is a really big but that might comfort our manual traders listening, the golden age of HFT just printing money hand over fist is kind of over.
Really, I just assumed they were all buying private islands.
The revenue for pure HFT firms has collapsed from its peak. Some data shows it's down nearly 86% from the highs in the late 2000s.
Why? If they have this incredible tech advantage, why aren't they winning?
Competition. It's a zero-sum game. If everyone has a Ferrari, nobody is faster than anyone else. The cost of the technology, the data feeds, the co-location fees, the talent, it keeps skyrocketing. But the edge, that tiny spread they're capturing, keeps getting smaller and smaller as more machines compete for it.
So the sharks are eating each other.
Essentially, the industry has consolidated into just a few massive players who can afford the arms race. But for us, the observers, the good news is that it means the market's behavior has settled into more specific, identifiable patterns. The Wild West days are gone, and now we're in the industrialized phase.
And industrialized means standardized.
Correct. And standardized means...
Predictable.
Exactly.
Which brings us to the meat of this deep dive. If these machines are standardized, if they follow rules, then we can identify them. We can go bird watching, or I guess bot watching.
Let's open the bestiary.
I love this concept from the RedTeam report. Treating these algorithms not as some unknowable black box, but like animals in the wild that we can spot based on their behavior and their tracks.
It is the most useful way to think about it. You don't need to know Python or C++ to trade against these guys. You need to know their habits. You need to be a good tracker.
Okay, let's start with species number 1, the range-bound algo.
Right. This is the mean reversion machine. This is probably the most common bot you will encounter in a quiet, sideways market. Its core belief is simple. Price is elastic. If it goes up too much, it should come down. If it goes down too much, it should go up.
So it's basically playing ping pong between two levels.
Exactly. It identifies a range, a support level at the bottom, and a resistance level at the top. And it just buys at the bottom and sells at the top over and over.
But humans do that too, right? We look at a chart, we draw a line with a crayon, and we say support is around $50.
But listen to the language you just used, around $50. Humans trade in zones. We're fuzzy. We think, $49.80s, $50.10, that's close enough.
Right. I see where this is going.
The machine does not do fuzzy. The absolute key footprint of the range-bound algo is unnatural precision.
Give me an example of what that looks like on a chart. You're watching a stock, say the S&P 500 futures. It drops to $4,250.00, exactly, to the tick, and it bounces hard. Then it comes back down an hour later. It hits $4,250.00 again, not 4,249.75, exactly the same number. That is not a human. That is a line of code saying, if price equals $4,250.00, then buy away.
It's too perfect. The lack of randomness gives it away.
It's surgical. Another visual cue is the candles. You'll see what the report calls uniform rejection candles.
Meaning they all look the same.
Identical. The wick at the bottom is the same length. The body of the candle is the same size. It's like a rubber stamp because it's a loop in the code. If price equals X, execute Y. It does it the same way every single time. There's no emotion, no hesitation. Okay, so that's the range-bound bot. It's the herbivore of our ecosystem. It wants things to stay the same, but markets don't stay the same forever. So what happens when the piece is broken? Enter species number 2, the breakout algo.
This is the predator that eats the range-bound algo for lunch. This bot is scanning for those same key levels, like that 4,250 we just mentioned. It knows there are buy orders there from the range bots, but it also knows there are stop-loss orders from short sellers just below it.
It smells the blood in the water.
It does. Its entire purpose is to detect a breach of that key level. If the price cracks 4,250.01 on the upside, or 4,249.99 on the downside, this algo triggers instantly.
And I'm guessing it doesn't trigger quietly.
No. This is the Kool-Aid man busting through the wall. The defining footprint here is the sudden volume spike. We are talking volume surging 3, 5, even 10 times the normal level in a matter of seconds.
And crucially, this often happens without any fundamental news, right?
That's the key. You're sitting there, the newsfeed is quiet, the CEO is on vacation, and suddenly, bam!
Yeah.
A massive green candle appears out of nowhere on insane volume.
What's causing that?
It's the cascade. The first breakout algo triggers. Its buying pushes the price up. That move then triggers the stop losses of the people who are betting against the move, the short sellers. Their stop losses are buy orders, so that adds more fuel to the fire, pushing the price higher, which then triggers the next breakout algo from a different firm that was waiting for confirmation.
It's a domino effect. One pushes the next.
Exactly. The visual cue on the chart is a long body candle with almost no pullback. No wicks on the top or bottom, just goes. A Marubozu candle for the technicians.
That explains those moves where a stock just seems to teleport upwards, and you're sitting there scratching your head wondering what you missed.
You didn't miss a news story. You missed the technical trigger that set off the machine cascade.
Okay, species number 3, the market maker, or the spread scalper. We touched on these guys earlier. They are the house in the casino.
They are, and they are tricky to spot because, by design, they want to be invisible. Their goal is to buy low and sell high simultaneously thousands of times without ever making a big splash.
So how do we catch them? What's their footprint?
A couple of things. One is looking for stable spreads even when the market is volatile. But the spookier footprint, and this is one of my favorites, is what's called ghost orders, or flickering.
Flickering.
For this, you need level 2 data, the order book, which shows all the buy and sell orders. You'll be watching and you'll see a huge block of shares for sale. 50,000 shares. A massive wall. But the moment the price gets close to touching it, it vanishes.
Poof, gone.
And then it reappears 3 ticks higher. Then it vanishes again when the price gets close. It's flickering in and out of existence.
What are they doing? It's not a real order.
It's a real order, but they have no intention of letting it get filled. They are spoofing. It's an illegal practice, but hard to prove.
Yeah.
They're trying to scare you. They want you to think there is huge resistance at that level, so you'll get scared and sell your shares to them at a cheaper price. They are herding the sheep with a ghost wolf.
That is devious. The report also mentions something called a machine gun pattern in the time and sales data.
Yes. If you look at the actual tape, the list of every single trade that happens, you might see a stream of identical small lot sizes, like 100 shares, 100 shares, 100 shares, 100 shares, executing milliseconds apart.
BERT, like a burst of automatic fire.
Exactly. That is a market maker algo chopping up a larger position or managing its inventory. Humans don't trade like that. If I want to buy 1,000 shares, I buy 1,000 shares in one go. I don't click the buy button 10 times in the span of 4 milliseconds.
Right. Okay, species number 4. This one sounds massive, the iceberg.
This is the TWAP, which stands for time-weighted average price, or the VWAP, volume-weighted average price algorithm. This is the tool used by the whales, pension funds, mutual funds, sovereign wealth funds.
The big money.
Imagine you're a portfolio manager and you need to buy 1 million shares of Apple. You cannot just go into your broker and click market buy.
You'd spike the price instantly. You'd cost yourself millions just on the entry.
Exactly. You'd become your own worst enemy. So you use a VWAP algo. The goal of this algorithm is to slice that giant 1 million share order into tiny, bite-sized pieces, maybe 500 shares at a time, and execute them slowly over hours or even days.
So it's the opposite of the breakout algo. It wants to be quiet.
It wants to be invisible. The footprint is called price creeping. It's like watching a glacier move. The stock just drifts slowly, relentlessly in one direction. There are no huge spikes, no drama. Just a steady, quiet grind, upwards or downwards.
And how does the volume look during this?
That's the big tell. Normally, market volume is a U-shape, right? High at the open, it dies down at lunchtime, and then it picks back up into the close.
Right, the human rhythm of the trading day.
But if you see steady, consistent, slightly elevated volume right through the middle of the lunchtime lull, when things should be quiet,
That's the iceberg.
that's the algorithm patiently working its order or trying to hide in plain sight. It can't hide the volume, though.
That's a super useful thing to know. If I see that steady creep, I know there's big institutional money pushing it.
Exactly. And the lesson is, don't stand in front of the glacier. It will not stop for you.
And finally, species number 5 in our bestiary, the HFT scalper.
The mosquitoes.
The mosquitoes, or the piranhas, yeah. They are doing millisecond arbitrage, capturing tiny price differences between exchanges. The footprint here is just noise.
Yeah.
Rapid oscillation. If you look at a 1-minute chart of a stock dominated by HFTs, it just looks like a barcode or a seismograph during an earthquake.
Yeah.
Up, down by tiny amounts.
And phantom liquidity again here, I assume.
Absolutely. The order book looks thick and full of liquidity. But if you as a manual trader try to place a limit order inside the spread, you will never get filled. They are faster than you. They see your order coming, and they move the goalposts before you arrive.
Okay, so we've identified the animals. We know what they look like. Now let's get into the forensics. Section 4. The RedTeam report goes deep into how to physically read the chart to confirm their presence. They mention volume as the primary weapon for us. Volume is the one thing that is hardest to hide. You can fake price moves with spoofing, you can flicker orders, but executed volume is executed volume. If a trade happened, it happened, and it leaves a record. It's the truth serum of the market.
There's a concept here called volume dry up that I've found fascinating. It's the calm before the storm.
This is a critical, and I mean critical, signal for anyone listening. Before a major breakout algo strikes, often the market maker algos, the ones providing that ping-pong liquidity, will sense the growing imbalance in the order flow. They can see the tidal wave coming before we can.
So they get out of the way.
They pull their orders. They don't want to get run over. Their job is to make money on the spread in an orderly market, not to be the hero that stands in front of a freight train. So right before a massive breakout, you will often see liquidity and volume drop off a cliff. The tape goes silent.
That is so counterintuitive.
Yeah.
You'd expect activity and volume to ramp up into the move.
The activity ramps up during the move, but the split second before, the smart machines step aside. If you are watching a stock consolidating at a key resistance level and suddenly the volume just dies, hold your breath. Something is about to break.
That is a pro tip right there. What about the flip side? A concept they call absorption.
Absorption is incredible to watch. It's when you see heavy selling hitting the bid lots of red prints on the tape. People are dumping stock, but the price doesn't move down. It's stuck.
So there's all this selling pressure, but the price is hitting an invisible wall.
Exactly. It means there is a massive hidden buy order, an iceberg, sitting there just absorbing every single sell order that comes in. An algo has been told, buy everything you can at $50, but don't let the price go below it.
It's like trying to hold a beach ball underwater.
That's a perfect analogy. The sellers are pushing the ball down with all their might, but the algo's buy order is holding it there. And once the sellers run out of ammo,
The ball shoots up out of the water.
it rockets. If you see absorption-heavy volume, but no downward price movement at a support level, that is a very powerful reversal signal.
The report also talks about candle symmetry. We touched on this, but let's go a bit deeper on the difference between messy human candles and clean algo candles.
Humans are emotional. We get FOMO, we panic buy, we rage sell. Our candles reflect that. They have long wicks, they have different sizes, they're erratic. Algos are mathematical. They often produce candles that are very proportional, very clean looking. But the one to really watch for is the V shape.
The classic V-shape recovery.
This is the signature of the news algo, or the sentiment algo.
These are the ones reading Twitter, right?
Reading Twitter, scraping headlines from Bloomberg, reading earnings reports, they use natural language processing, or NLP, to interpret text.
And how fast are we talking?
A headline hits the wire. Fed hints at unexpected rate hike. The algo reads it, its dictionary associates hike with negative sentiment, and it dumps stock within milliseconds, faster than you can read the first word of the headline.
That explains the initial, perfectly straight line down on the chart.
But here's the catch. Often, that initial reaction is purely based on keywords. It doesn't understand nuance or context. It's a brute force overreaction.
So the math recalibrates itself.
Exactly. A few seconds or minutes later, other more sophisticated algos, or even the same ones, realize the move was too big or the news wasn't actually that bad in context, and they buy it all back just as quickly. You get a sharp drop and an equally sharp recovery. A perfect V on the chart.
So if I see a perfect V-shape, I know it was likely a bot reacting to a headline, and it probably overreacted.
Correct. And the key for a human trader is that chasing that initial spike either up or down is suicide. You are way too slow. The trade is to either fade the initial move or wait and buy the bottom of the gi or just stay out of it.
This transitions perfectly into the strategy section, section 5, the RedTeam approach. Their core principle, which I love, is read, don't fight.
Which is the only logical approach. It's the central thesis. You cannot beat a computer on speed. You cannot beat it on raw calculation. But you can beat it on context and adaptability.
Context.
The algo knows price, volume, and math. It follows its rules. It doesn't necessarily know that the CEO who just resigned is the heart and soul of the company, or that a geopolitical event is shifting global sentiment in a way its code can't quantify. It just follows its programmed rules. Humans can see the bigger picture.
So let's go through the situational response matrix they provided. This is the if this then that for us humans.
Right. Let's play it out. Scenario 1. You identify a range-bound algo as active. You see those perfect surgical bounces at precise levels.
What's the play? What do I do?
You trade the bounce, you become a ping pong player. You do not try to trade a breakout.
What?
Because the algo is programmed to defend that range. Its entire reason for being is to keep the price inside the box. If you try to anticipate a breakout and buy at the top, the algo will just slam it back down and you'll get stopped out. It's a false breakout factory. You ride the ping pong game until the footprints change.
Okay, scenario 2. The breakout algo triggers. The volume spikes, the level breaks clean.
Here, the rule is wait for confirmation. Do not chase the first candle. I know it's tempting.
But I'll miss the move. My FOMO is kicking in just thinking about it.
You might miss the first 10% of the move, but remember the V-shape. Remember the false breakouts we just talked about. If it's a real breakout algo, there will be a domino effect. The volume will follow through. Wait for the second or third candle to confirm that the move is holding. It's better to catch the middle 60% of a real move than to get caught in 100% of a fake one.
Patience pays. Okay, scenario 3. We spot the VWAP, the iceberg or the glacier, the steady creep.
This is the easiest one to piggyback. If you see that steady, relentless creep and that flat, unusual volume, an institution is accumulating or distributing. Don't counter-trend it. Don't try to short a stock that is creeping up. You are standing in front of a train that is moving slowly but has infinite mass.
Just get on the tray.
Exactly. Go with the flow. The institution wants the price to stay stable while they buy, so they will support any dips. It's a much safer, lower volatility trade.
And scenario 4. HFT scalping is dominant. The barcode chart, the noise.
Do not trade.
Just walk away from the screen.
If you are a manual trader, that noise will eat you alive. The spread costs, the commissions, the false signals. It's a meat grinder. If you see that rapid oscillation, that barcode pattern, you zoom out.
Go to a higher time frame.
Yes. Ignore the 1-minute chart completely. Look at the 15-minute or the hourly chart. The HFT noise almost disappears on the hourly chart. It's irrelevant to the bigger trend.
That's great advice. Don't get hypnotized by the noise. Now, there's a really interesting concept here called detecting transitions, the money move, because these algos switch modes, right?
Yeah.
The market environment changes.
They do. Markets are not static. They go through regimes. And catching the moment a stock goes from a range-bound sleepy state to a breakout state is where the big life-changing money is made.
So how do we spot the transition? What are the tells?
Look for a narrowing range. If that ping pong game is getting tighter and tighter, if the bounces are getting smaller and the price is coiling like a spring, the range-bound algo is losing its grip, it's running out of room,
It's building energy.
it's building energy. Also, watch for failed bounces. If the price has been hitting a resistance level of, say, $100 perfectly for 5 times, but on the 6th try it only gets to $99.80 and rolls over, that's a sign of weakness. It implies momentum is building to the downside. The breakout algo is loading up its shorts.
And what about the reverse? When a strong trend is getting tired and ready to go back into a range?
You look for diminishing returns. If the breakout candles are getting smaller and smaller and the pullbacks are getting deeper and more frequent, the regime is shifting back to mean reversion. The momentum is gone. The buyers or sellers are exhausted.
It's like reading the energy of the room at a party. You can tell when it's peaking and when it's starting to die down.
It is. It's reading the footprint of the capital flow and its intensity.
So we've covered the present. We know the animals. We know how to track them. But what about the future? Section 6 covers the bigger picture, and it gets a little sci-fi. It mentions AI and machine learning.
This is the next frontier, and in many ways, it's already here. Everything we've discussed so far is largely rule-based or ETHN algorithms, but the new generation involves deep reinforcement learning, or DRL.
What's the fundamental difference?
A rule-based algo does exactly what it's told. An AI algo learns. It runs millions of market simulations in a virtual environment and figures out novel strategies that no human ever programmed into it. It adapts on the fly.
So it's not just buy it support. It's, I've seen this specific multivariable pattern 50,000 times in my simulations, and I've learned that the highest probability move from here is X.
Exactly. And there are new types, like directional change DC algorithms. They don't look at time-based charts like we do with 1-minute or 5-minute candles. They look at events. They track the intrinsic rhythm of the market based on price swings of a certain magnitude.
It sounds much, much harder to predict.
It is, because they are evolving. And then you have the exponential growth of sentiment analysis with natural language processing. Algos are not just reading headlines for keywords anymore. They're reading entire earning call transcripts. They are analyzing the tone of the CEO's voice.
Wait, they're analyzing voice stress?
There are funds doing that right now. If the CEO's voice shows a higher than baseline stress level when answering a question about inventory, the algo sells before the CEO even finishes the sentence.
That is simultaneously dystopian and amazing.
And regulators are scrambling to keep up. We're seeing things like kill switches being mandated in some countries. Like in India, their regulator, SEBI, requires system audits and the ability for the firm to shut its algorithm down instantly if it goes rogue.
And what about the order-to-trade ratio we mentioned?
That's a penalty for spamming the market. If you place 1,000 orders and only execute 1, you might get fined. It's an attempt to stop the, quote, stuffing and spoofing we talked about earlier.
But the big players have another hiding spot, right? A place to avoid all of this. Dark pools.
Ah, yes. The name says it all. If you are a massive institution and you don't want the HFT sharks to see your giant order coming and front-run you, where do? You go off exchange to a private trading venue called a dark pool.
So the trade happens, but the footprint is hidden from the public market.
The trade happens privately between two parties, brokered by the dark pool operator, which is usually a big bank. It doesn't hit the public tape until after it's completed, and often it's reported in a way that obscures the true size. It's a way to bypass the forensics we just discussed.
So there's a whole other ocean underneath the one we can see.
Precisely, a massive, murky one.
Okay, this has been incredibly eye-opening. We've gone from the sheer scale of machine dominance to identifying the species, reading their footprints, and knowing when to engage and when to get out of the way.
It's a lot to take in. It changes how you look at a chart forever.
So let's summarize. What's the one big takeaway for the listener who's trying to make sense of all this?
The takeaway is that the market is a conversation. But it's no longer a conversation between two guys in suits yelling at each other in a pit. It's a conversation between humans and machines, and mostly it's machines talking to other machines.
And we are the eavesdroppers.
We are, and we can be very profitable eavesdroppers. If you accept that the machine is faster, you stop trying to race it. You start analyzing its behavior. You look for the volume dry up. You look for the ghost orders. You look for the perfect V shape. These are the fingerprints of the invisible hand.
I love that. Read, don't fight. It's about being the strategist, not the soldier. So here is a final provocative thought for everyone listening. We talk about AI learning. We talk about machines analyzing the stress in a CEO's voice. as these algorithms move from just executing orders to making strategic decisions, actually deciding what to buy, not just how to buy it. Are we approaching a singularity in finance?
That's the billion-dollar question, isn't it?
Will human intuition, our gut feeling, become completely obsolete? Or will the human edge, our ability to understand context, politics, culture, the sheer absurdity of the world, always be the one thing that code can't truly replicate?
I'd like to believe context is king, and that a human will always be needed to understand the why, but the machines are learning very, very fast.
That is definitely something to chew on. For tomorrow morning, though, here is your call to action. Open your chart, any chart. Don't just look at the price. Look at the volume. Look for the silence before the spike. Look for the ghost orders flickering on level 2. See if you can spot the invisible hand moving the pieces on the board.
Happy hunting.
Thanks for diving deep with us. We'll see you on the next one.